and Apache common stock in a watch list, because all of the ETFs and Apache itself are still bullish but experiencing pullbacks. So we think there'll be an opportunity, maybe in the not too distant future, for a trade in either one of the ETFs or in Apache. So we want to set up the watch list, and we want to just have the information available so that we can check it maybe once or twice a day, or as often as necessary, to see if we can get a bullish trade out of it. And what we did was we placed Apache in each of the ETFs in the trend charts. We set the time frame at 65 minutes for the charts, and we set up bullish alerts for Apache in each of the ETFs using strict rules, which means that both the momentum indicator and the trend indicator have to be in the correct position, the correct bullish position, to trigger an alert. But when and if an alert is triggered, this little panel here on the lower right corner, and the locations of each of these little panels matches the big chart position. When a bullish alert is triggered, this little panel will turn all green, and then we can take another look at either the Apache or the ETF chart and see if we want to make a trade at that moment in time. Now, one thing we did was, in anticipation of a potential trade in Apache, we downloaded the Apache option chain from the CBOE. And again, the first thing we usually do is we'll just flip on call open interest, and we can see that open interest is decent. It goes down into the 500s. We like to go deep into the scroll with 500s, but we can see that well, the 43-day expiration cycle appears here. So there's some good liquidity in the 43-day to expiration cycle. And just to see which cycle that is, we'll look at the Friday expirations calculator, and the 43 days is it's the third Friday in July, which means it's the regular expiration cycle. So although Apache does have weeklies, the regular expiration cycle has the best liquidity. So let's scroll down or sort by days too. We'll get down to 43 days to expiration, and we're going to just demonstrate how to use the strategy preview. Click the strategy preview, and the first thing we want to do is drag and drop the stock price. And we're going to just enclose this a little bit. We're going to shorten it so we can see both. The strategy preview chart will always stay on top. And we're just going to set up a spread and just take a look at what kind of risk reward it'll provide us with. And what we're going to do is we're in the 43-day cycle. We're going to buy the 70 delta call, and the mid price is about 470, and we're going to sell the 30 delta call, which is this one right here, and the mid price is 111.55. Alright, let's expand now. I guess we don't need it that big. And this is a debit call spread. We click the button, and we get information about the possibilities or the risk reward of this trade. And again, we'd be buying to open the July 15th 52.50 call, which is in the money and is about a 70 delta, and selling the July 15th 60 call, which is out of the money and is about the 30 delta. We can see this position would cost us about $355. Our probability of profit is 47%. That's a little under 50. The most we can gain from the trade, because it's a spread trade, is $396, and our break even is $56.05, which is only 55 cents above the current price. If we just made it a long call, let's just say we bought the July 15th 52.50 call in the money, we can see that the break even would have jumped up to 57.20, which is more than a point more than what we're doing now. And I'm going to clear these results. I'm going to drag back in the stock price, and just want to show you something about buying out of the money calls. For example, if we just bought the 60 call, and it's a long call, we can see that the break even, it cost us a lot less. It cost us $2 less, but the break even jumped up to 61.16. So we had a break even of about 55 cents for the spread, and the break even now is 61.16, which means if Apache went to $61.15 on expiration, you would lose 100% of your money. It has to be above 61.16 to make even 1 penny on the trade. So the spread provides a much lower break even and still a pretty decent profit opportunity. But I just wanted to demonstrate to you the strategy preview chart. It's really set up to do simple spreads, just credit and debit spreads without getting too sophisticated. But it's a real good tool to, number one, learn what your probability of profit is, how much buying power, how much this trade or spread or individual option is either going to cost you, how much credit you're going to get, and what the break evens are. I mean, that's critical information that you need to know before you do a trade. And just want to demonstrate one other thing quickly. We mentioned the volatility rank yesterday, but if this is a little trick you can do. If you call it and then minimize it, you can go to the iVolatilityCom website, which we've already done, and we've called up Apache. But you can pop up the volatility rank little window and fill it in right in place, so you don't have to remember anything. So it's 38.05. The high volatility for the year has been 71.55, and the low has been 23.53. 23.53. Click calculate, and we can see that the implied volatility rank or percentile is about 30. And 30 or less, the stock or the option is in position for you to make a long trade, a debit trade, versus selling premium. In this case, we can buy premium when the time is right. So just a quick review. We set up Apache in 3 ETFs. We set up the alerts in the trend charts window. We can see that XOP has alerted. We'll have to follow up on that. And we did a Apache download of the option chain, sorted by open interest. We found out that the 43-day cycle, which is the regular July expiration, had pretty good liquidity, and we used the strategy preview button to just look at a couple different possibilities for an option strategy. Now, I would spend a little more time doing each of them before making an actual trade, but just wanted to give you an overview of some of the tools that are available.